When we talk about investing, most of the attention in the last couple of years has been on sectors like manufacturing, defense, and capital expenditure. But today, the conversation is slowly shifting towards a sector that is often ignored, yet extremely important: healthcare. Now, this may not sound very exciting at first. It is not on high momentum sector. It is not always in the headlines. But here's the interesting part. Healthcare is what we call a defensive growth sector. It has the ability to provide stability during uncertain times and at the same time benefit from long-term structural growth. And that's exactly what we are beginning to see in 2026. Hello investors and welcome back to the Equitymaster channel. I am Mitali Dhoke, research analyst here to simplify mutual fund investing and guide you on a smarter wealth creation journey. After a phase of consolidation, the healthcare sector is slowly showing signs of recovery. Pharma companies are emerging from pricing pressure in key export markets like the US. Domestic demand in India continues to remain strong. And beyond pharmaceuticals, the entire healthcare ecosystem, hospitals, diagnostics, and specialized care is expanding steadily. At the same time, innovation in areas like biologics and specialty drugs is improving long-term growth visibility. So it is not a sharp rally, this is a gradual build-up of opportunity. And when a sector is in this phase, that's when long-term investors start paying attention. So let's now look at 3 healthcare mutual funds that may have a potential to grow in this trend. The first fund is SBI Healthcare Opportunities Fund. This is one of the oldest and most established healthcare fund in India. It provides exposure across pharmaceuticals, hospitals, and diagnostics, capturing both global and domestic opportunities. The strategy here is relatively balanced. Large-cap pharma companies provide stability. Mid-cap exposure adds growth potential. This combination helps in managing volatility better compared to more aggressive sectoral funds. In terms of positioning, the fund has meaningful exposure to hospital chains, diagnostics, and specialized healthcare segments. Within its healthcare allocation, Apollo Hospital Enterprise Limited holds the highest weight of around 5.76%, offering exposure to India's expanding hospital ecosystem. Aster DM Healthcare Limited, with around 3.85% of holdings, and Fortis Healthcare Limited, with 3.24%, further strengthen the portfolios present in multi-specialty healthcare services. While Jupiter Lifeline Hospital Limited, at 2.79%, adds exposure to emerging hospital chains. On specialized side, Concord Biotech Limited, 2.16%, provides biotech exposure. Nephrocare Healthcare Services Limited, 1.17%, focuses on niche dialysis services, and Vijaya Diagnostic Center Limited, 0.62%, represents the diagnostics segment. However, being a sectoral fund, it comes with concentration risk, so it is more suitable for investors who have a higher risk appetite and a long-term investment horizon of at least 3 to 5 years. The second fund is LIC Mutual Fund Healthcare Fund. This fund is relatively smaller in size, but it takes a more flexible approach. It invests across large cap, mid cap, and even selective small cap healthcare companies. The idea here is to capture growth across different segments of the healthcare ecosystem. Because of its smaller size, the fund has the ability to take more selective and focused bets. Within its healthcare allocation, Apollo Hospitals Enterprise Limited, 6.87%, holds the largest weight, highlighting strong exposure to hospital-led growth. Fortis Healthcare Limited, 4.94%, further strengthens the portfolio's presence in multi-specialty healthcare services. While Concord Biotech Limited, 3.05%, adds exposure to the biotech segment. Dr. Agarwal's Healthcare Limited, 2.18%, complements the portfolio with a focus on specialized eye care services. This flexibility could work well when the sector performs, but it may also lead to higher volatility during weaker phases. Its performance has been relatively inconsistent compared to larger peers, which is quite typical for sectoral funds. However, in the current phase, where valuations are reasonable and demand is improving, the fund could have a potential for growth from a gradual recovery. The third fund is Aditya Birla Sun Life Pharma and Healthcare Fund. This is a relatively established fund with a growth-oriented approach. It combines stable large-cap pharma companies with selective mid-cap opportunities. This allows the fund to participate in both export recovery and domestic healthcare expansion. From a performance perspective, it follows a typical sectoral pattern. Short-term returns may appear moderate, especially during consolidation phase. But over a longer horizon, particularly 3 to 5 years, the fund has delivered healthy double-digit returns. This reflects its ability to capture sectoral upcycles effectively. Within its healthcare allocation, Apollo Hospitals Enterprises Limited 7.78% holds the highest weight, indicating strong exposure to the hospital segment. Fortis Healthcare Limited 4.17% further strengthens its position in multi-specialty healthcare services, while Jupiter Lifeline Hospitals Limited 1.94% adds exposure to emerging hospital networks. The portfolio also includes Thyrocare Technologies Limited 1.63% and Vijaya Diagnostic Center Limited 0.92%, providing representation in the diagnostic space. And with improving earnings visibility in the healthcare space, the fund could look forward towards the next phase of growth. Now, before you consider investing in any of these funds, there are a few important things to understand. Healthcare funds are not momentum driven. They do not perform consistently every year. Instead, they move in cycles. Their real value lies in capturing long-term trends, such as rising healthcare spending, aging population, and increasing demand for quality medical infrastructure. So, timing the entry is less important. What matters more is staying invested through the cycle. At the same time, since these are sectoral funds, over-allocation could increase risk. So, they should ideally be used within a diversified portfolio. So, the key takeaway is very simple. The healthcare sector in 2026 is not at its peak, it is in its early stages of recovery. And that is typically where long-term opportunities begin to build. Instead of chasing short-term performance, focus on disciplined allocation, patience, and long-term perspective. So if you like this video, please subscribe to our channel. Invest wisely, happy investing. The securities quoted are for illustration only and are not recommendatory. Past performance is not an indicator of future returns. This video is for information purpose and does not constitute any kind of investment advice or a recommendation to buy, hold, sell a fund. Returns mentioned herein are in no way a guarantee or a promise of future returns. As an investor, you need to pick the right fund to meet your financial goals. If you are not sure about your risk appetite, do consult your investment consultant or advisor.